Today we're doing a very, very special event with Melissa Meneses of the Nevada Rural Housing Authority. We're going to be talking about the wonderful non-repayable down payment assistance grants that are available through Melissa's organization. I'm Doug Kaller of Academy Mortgage. We're soon to be joined by my partner, Regina Lockwood of Ferrari-Lund Realty. And we're going to be talking about all these wonderful programs to help you get into a home. There are a lot of myths out there about people believing that they can't afford to buy a home, that they don't have the money for a down payment, they don't have the money for closing costs, and the Nevada Housing Authority has the solution for you. How are you today, Melissa?
Good morning, Doug. I'm great. How are you?
We're doing great. We're happy to be here.
Yes, thank you for having me.
And we're going to be talking about your program. Why don't you tell us a little bit about the Nevada Rural Housing Authority, about its mission and its history, and exactly what you do over there?
Absolutely. So, like Doug said, I work at Nevada Rural Housing Authority. I work in the Home at Last department. We help people get into homes with down payment assistance. Our mission is to promote, provide, and finance affordable housing opportunities for all Nevadans. We were created in 1973. The Home at Last department came into fruition in 2006, and as of today, we've helped 4,700 families.
Wow.
Really exciting. So I am the Home at Last specialist. So what I do is I go out and I market our program, let our homeowners know about our program, work with lenders and realtors, try to get the word out as much as I can.
And so many people can benefit from your program. We have people in our studio audience this morning that are in contract for a home down in Yarrington, and they're going to be utilizing this program. It's going to help them literally get into the home with no money out of pocket.
That is amazing. I know I spoke with them before coming on air, and what a great story they have.
Right. And, a short couple of weeks ago, you and I were out visiting a family in Fallon that just purchased a home there, and in fact they did a little video that we put on Facebook, and what they said was they would not have been able to buy their beautiful home there without the help of your grant. And their grant was actually $11,300. Can you imagine what you could do with $11,300?
That is so awesome. And what a great family they were. The home was gorgeous. So nice to meet them and see our programs actually working.
Right. Let's get started. Let's talk about Home at Last. And you actually have various programs. You have the grant program, which offers grants of 2 to 5%
yes.
of your loan amount. And then you also have programs for first-time buyers and for veterans.
We do. It's called the Mortgage Tax Credit Program. And our Mortgage Tax Credit Program is dollar for dollar mortgage tax credit paid. Excuse me, let me back up. It's dollar for dollar federal income tax credit. So we issue either a 20 or 30% mortgage tax credit certificate, and that's based on the loan amount. And so home buyers can receive an average of $2,000 a year.
That's amazing.
It is amazing.
The key to that is that you have to pay federal income tax in order for this to be a benefit. A lot of people that we deal with are particularly veterans that are on full disability, and their income is such that it's not taxed, and as much as we would love to give them an additional $2,000 a year where they're not paying tax, there's really no benefit for this program if you're not paying tax. But if you are paying federal income tax, this is just an amazing program. I call it the gift that keeps on giving.
That's absolutely correct. So we help you get into your home with down payment assistance, and then with the mortgage tax credit program, you can get money received every year thereafter for the life of the loan.
Right. Okay. Well, let's go back to the grant program. And now you can use the grant program for either your down payment or your closing costs.
That's correct.
Right. And as I say, that grant can be as well, it's as little as 2%. It's a maximum of 5%. Now, how does the different grant amounts affect your interest rate?
So if you have a 2% grant, I think it's 3.25%. And then if you go up to the 5%, it's about 5% on the interest rate.
Right.
So it varies depending on the loan amount and the down payment assistance type that you will be using.
Right. Okay. And we love to call this free money. And when I was first working with the Nevada Rural Housing Authority, doing their down payment assistance programs, these programs were a second mortgage. And so you received a small amount of money to help cover your closing costs, but you were borrowing that money as a second mortgage and having to pay it back. Also, when you were borrowing the money for the second mortgage, it had with it what we called recapture tax. And a couple of years ago, Nevada Rural changed the program. They did away with the second loan, and now it is truly free money. It's a free grant that you receive, so you don't have to pay it back. And the other thing that's really neat is that back in 2014, the Nevada legislature passed a bill where there no longer is recapture tax associated with these programs. So, in the past, when there was recapture tax, you were expected to stay in the home for basically 9 years. And with the new program, that's not an issue at all. You don't have to worry. Good morning, Regina.
Good morning. I want to explain that there's some jog in my neighborhood. Does anybody know?
Yeah, there's a run today.
What is this run?
I think it's a 5K, and it's downtown Reno, and
Mayberry and Plum, where
yes,
I live.
Yes.
Yes, I got involved with it driving in this morning also, and had to do some maneuvering to get around it, and was complaining when I got here.
Well, you know how close to the deadline I always run, and then
right.
you add a run into it.
And the police are making you go 15 miles an hour and stopping you for every runner that wants to cross, and blah blah blah. And we're like, okay, this is not the good morning for me. So anyway, but good morning, guys. How are you?
Good morning.
Great.
Good.
So we're talking about the down payment assistance grants, and we did mention the mortgage tax credits before, but
well, I heard you just say about the recapture tax and staying in your house for 9 years. You know, that is an eternity when somebody buys a house. You do not want to be committed for 9 years because you just don't know what's going to happen in your employment situation, your family situation, your health. So many factors make it difficult to say, I'll be here for 9 years for sure. So that was a great move when they did away with that.
Right. So many people shied away from the program.
Because of that.
Because they felt that they were taking on too big a commitment. They were worried about what the impact of that would have been
if they had to leave and repay or pay back grant programs,
exactly.
etc.
And so the way that it's set up now is if somebody and recapture is a federal law. It's not a Nevada law. So if you were to sell your home and for some reason you were required to pay the recapture, on Melissa's website there's a form, and you just fill out the form, and then the Nevada Rural Housing Authority rebates that money back to you that you paid to the federal government.
Oh, so it's absolutely covered.
And that's for the mortgage tax credit program.
Right.
Awesome.
Right.
Hey, have we given out the numbers for people to call us with their questions? Or
no,
text
we
us?
have
Not yet.
Well, we need to do that. Why don't we let everybody know that if you want to call in to the Home Buyers Seminar and get questions answered about how you might get grant money and tax credits to purchase a home in 2016, why don't you give us a call at 844-790-8255. Or if you're a little shy to go on the air, you can text us your question at 775-237-2266. So we'd love to hear from you. I'm Regina Lockwood, a residential realtor with Ferrari-Lund Real Estate, Doug Kaller from Academy Mortgage, and Melissa Meneses from Nevada Rural Housing Authority.
Yes.
So, and we're talking about the program to get free money. And, you know, Melissa, I was reading through some of the slideshow slides and things, and I thought, you guys do now put it in bold print, free money. And so we're totally legit to talk about that.
Yes.
That's great.
I know that my company really does not like us to use such terms, but that's what it is, and so many people have benefited from this. Melissa was saying before, at this point, they've helped 4,700 people with this program.
That's great.
It's just amazing.
And we have a couple guests in the audience here today. Does free money sound exciting to you guys? Is that what you're interested in? Yeah, they're shaking their heads. It's definitely something that brings the audience out. So where were you guys? You were talking.
Well, we're up to now as far as the mortgages that you do. A lot of people are so concerned that the loans that they get, they're going to be an adjustable mortgage, or their terms are going to change. With your programs, what type of mortgages are these?
It's a 30-year fixed.
Oh, wow. That makes it really great that with a 30-year fixed, the nice thing about that is that you know exactly what your housing payment is going to be for as long as you stay in the home.
Absolutely. People are afraid because of the things that went on in the housing crisis, that there's some secret, that there's going to be a hidden caveat that they didn't know their payment was going to go up after 3 years or 5 years or 7 years, and this is not going up. What you get now is what you're going to pay.
Right. And the other thing is that home prices in this area have been appreciating. In fact, I printed out an article this morning where home prices in the Reno market were appreciating at the fastest rate of anywhere in the country. And with that in mind, when housing prices go up, guess what goes up with them? I'm sure Regina can tell us that.
Well, the house payment or the interest rate? What are you talking about?
No, when house prices go up, rents go up.
Oh, yeah, absolutely. Everything related to housing goes up. Every single thing goes up.
And what we used to figure that when we were anticipating somebody's change in rent, we used to figure it at about 2% a year. So your rent went up $25.
And that's just basically because the person who owns the house thinks, oh my goodness, all of a sudden I've got all this equity in this house. If I sold it, I could have this much in my pocket. If not, if I'm going to keep it, then I need to be earning a return on the amount of money that's sitting there in equity. So they just think, gosh, it's time to raise everything.
Right. And, a few years ago, you could have rented a house for 70 or 75 cents a square foot. Today, it's up to $1 a square foot. People's rents are going up $200, $300 or more a month. And, how do you budget for that in the future?
Exactly. And that's where you're saying the point you're making is that if your house payment is fixed at $1,400 or $1,500, for 30 years, that's what your cost of putting a roof over your head is going to be. Whereas if you're renting, the cost could keep going up. Every time the landlord decides to issue a rental increase notice, the cost keeps going up. And then we're starting to get into the point where if you're paying $1,200, $1,300, $1,400 for rent and you could own for $1,500, it's so much of a financial value to you, a benefit to you to actually own.
Right. And the other thing is that when you do own, you get a tax, you're able to deduct the amount of interest that you paid from your gross income. So if you paid $5,000 in interest the previous year, instead of paying taxes on, say, $35,000, now you're paying taxes on $30,000.
Exactly.
But with that, if you're a first-time homebuyer or a veteran, Melissa's program, now all of a sudden you're able to get possibly $2,000
in tax credit, right?
Tax credit, and so that your actualized payment, your after all of your credits and so on, it's much, much less than renting.
Absolutely, absolutely. And then, just so that it's easy for you, you do get from your mortgage company an interest statement every year. They send you a piece of paper that says you paid this amount down to the penny, and so you don't have to go hunting for it and figuring it out and calculating it yourself. It's a form that they'll send you, and you can take that to your tax person and have your taxes prepared, and your money that you paid in interest will be deducted.
Right. When you sign your closing documents, You sign the form for that, and we always make the comment that this is the good IRS form.
You guys believe there's a good IRS form? Yeah, we do now. That's what they said. So,
what type of loan programs can people use or utilize with your program, Melissa?
Well, they can. Our products are available with FHA, VA, or USDA Rural Development. We have our own preferred conventional loan product as well.
Okay. And a lot of people think that if they have limited money for a down payment, that they have to go FHA. And actually, that's no longer the case, because your preferred conventional product you were talking about, the maximum financing on that is how much?
5% on that conventional loan product. You can get 5%.
95% financing, wouldn't that be?
Oh,
No,
yes,
no.
I'm sorry,
You
I
can get a
misunderstood.
5% grant, but actually with the conventional product today you only have to put 3% down.
Oh, okay, that's what you're talking about.
Right, as opposed to FHA is 3.5% down. So if somebody with good credit, and with the conventional product, if your credit score is below 680, then you do have to put 5% down. You get a 5% grant and you put 5% down. But if you have a score that's above 680, you can do Melissa's conventional product with just 3% down. But there's other benefits to that. And the one is that with mortgages where you're putting less than 20% down. And one of the big myths that a lot of people that are first-time home buyers are worried about is the idea that they have to put 20% down to buy a home.
Yes, everybody thinks that. Conventional 20%, and they don't know there's other options.
Right. And so with this program, you're able to put as little as 3% down. There is mortgage insurance till you have 20% equity in your home. Mm-hmm. But as far as if you were doing a regular 3% down conventional loan that was not through a housing finance agency such as the Nevada Rural Housing Authority, your mortgage insurance would have an annual rate of 1.31% for somebody with a credit score between 680 and 719. With Melissa's program, that's only 0.8%. So you're saving over 40% on your mortgage insurance, plus you're getting 3, 4, or 5% money toward your down payment. Free money, right? Exactly. So it's very, very exciting as far as that goes.
So it just underlines what we always tell people, that the housing prices are rising faster than you can save. So if there's any way that you can come in and see either of you and get pre-qualified and find out which program to use, you're far better off, because it really doesn't take that much cash anymore.
Right. One of the biggest problems that I find is that so many of the realtors don't quote, or they say that the people are getting the grant, and they think that if you're getting a 3% grant or a 5% grant, that's going to cover everything.
No.
And Regina and I work together all the time, and she's very aware that 5% does not cover a down payment and all your closing costs. You're still going to have to bring a little bit of money to the table.
Exactly. But there are other options for doing that as well, which people can gift you money. Family members can give you a gift letter. You might save $5,000-$6,000 and be able to cover it, but it would be really hard to save $20,000 or even $12,000.
Right, almost impossible for just about everybody.
Exactly. And then one of the things I tell people too, and I don't know how the loan officer likes this or not, but I tell people that when you close on a house, you pay at that table, the closing costs include the prepaid interest to the end of the month, okay?
Right.
And then you live in the house for a whole month before you owe anything. Unlike rent, where you have to pay on the first to live in it, like if you pay April 1st, it's for the month of April. Well, with a house, you get to live in it the whole month of April before a payment is due in May. And then I actually even tell people, and if you really need to, you can push it that the payment isn't due until the 15th. Right. So let's say we close mid-March here, okay? You wouldn't have a payment due until May 15th, which actually helps you acquire some cash. Because if you are used to on April 1st putting out a rent payment, on May 1st putting out a rent payment, this way, when you're buying a house, the payment isn't due until the middle of the next month, and so you can acquire a couple thousand in cash pretty easily that way.
And that's just so true. The difference between renting is that when you rent, you're paying for the upcoming month at the beginning of the month.
Right.
With a mortgage, you're paying in arrears. So when you make your payment on April 1st, you are paying the interest for the principal and interest for March. And it does allow people to get in the home and, they have a little bit of extra money if they're, you can use that money to help you move. You might need to buy a new appliance or something like that.
Or you might need it for the closing cost.
Right, exactly. So it's available to you, and it makes a big, big difference.
Yeah, that's a selling factor that I use a lot in my real estate practice.
Right. It's good to let them know, too, about closing costs. And if you're going to use something like a VA or USDA where there's no down payment, like the 2% grant with the 3.25%, that comes out at a $300,000 purchase price. It's about $6,000 that they could use towards their closing costs.
Oh, it's really great. If you've got one of those no down USDA, VA, then you're really only covering closing costs, and that is totally covered by the grant. That's the case where you can say no money out of pocket.
Right, exactly. And as far as we should talk a little bit about some of those other programs with USDA. Now, USDA, the property has to qualify for a USDA grant.
Means it's got to be in the right spot, the right place.
It has to be in a true rural area.
Right.
In Reno, the only place that I'm aware of where you can get a USDA loan is out in Cold Springs. But if you're buying a home in Fernley, you're buying a home in Dayton or Gardnerville or Minden, the USDA is just a wonderful product, and you're able to finance 100% of the purchase price with this product.
So that's no down payment, no money out of your pocket, then get a grant, cover your closing costs, and you can actually end up with more money than you need, in which case they apply it to the principal of the loan.
Right. You can pay down the principal of the loan.
Right. Actually, with, what I try to do when I'm talking to people that are doing a USDA or a VA loan is look at it and figure out which of the different grant amounts is going to be closest to you coming in with no money.
Right.
And rather than paying down your principal, if we can get it so that, if you had to come in with $200, that's not the end of the world if your interest rate is 0.25% or 0.3% less because you didn't get as large of a grant amount.
Right, and most people could scrape together $200 or $300 if it means that their payment is going to be $20 or $30 less every month for 30 years.
I know I could.
You know what? It's amazing.
I would make it happen.
It's amazing what you can do when you have to. In fact, I'm going to watch my son who gets paid on every other Friday, and yesterday, Friday, he asked me for money, which I said the bank of mom is closed. And so I didn't give him a dime, and I'm thinking, oh, now he's got a whole week before he gets a paycheck. If he's asking me for money on Friday and he doesn't get paid till next Friday, so I'm going to be interested to see how he comes up with money.
Yeah.
But people can, when they need to, they get very resourceful. You sell stuff, you call in your chips from your friends, all those kind of things. So not that we want you doing that if you're getting a house, but really you can scrape together a couple $100 to save massive thousands over 30 years,
The other thing that I think we have to consider when we're talking about the grant amounts is that because the grant is based on your loan amount, somebody who is buying a house that, for argument's sake is $100,000, and if they were to receive a 3% grant, that's just $3,000. Where somebody who is buying a house that's $300,000 and gets that same 3% grant, they just got a grant that was, or financed $300,000, they just got a grant that's $9,000. And
wait, I didn't follow your math on that. If somebody
bought a house for $100,000.
Oh, $100,000. Okay,
right.
I'm sorry,
okay.
Yes.
So the people who need the grant the most, who are buying the lesser price houses, the impact of the grant probably isn't quite as good because
They're buying a lower priced house.
Right, it's a percentage. And unfortunately, so many of the fees that are associated with a mortgage, they're a flat fee. If somebody's buying a house for $100,000 or a house for $300,000 or $400,000, a lot of these fees are the same no matter what,
right.
Regardless of the purchase price. So they're a little bit hurt by, their grant money doesn't cover as much when you're buying a lesser expensive house. The people who are able to afford a more expensive house, the bang they're getting for their buck with the grant is so much greater.
Well, then that leaves us with some things to talk about how to maximize the amount that you will qualify for, in terms of in tax season, and et cetera, and how to get your credit score up, which we will talk about when we come back right after this short break for the second half of the Home Buyers Seminar with me, Regina Lockwood from Ferrari-Lund Real Estate, Melissa Meneses from Nevada Rural Housing Authority, and Doug Kaller from Academy Mortgage. We'll be right back.
My name is Dale Pazinski. I'm 19 years old, and this is how I live united. I've always been
And welcome back to the Home Buyers Seminar here with me, Regina Lockwood, a residential realtor, Ferrari-Lund Real Estate, Doug Kaller, Academy Mortgage, and Melissa Meneses from Nevada Rural Housing Authority. We are talking to anyone who has a question about getting qualified for a home or getting qualified for the grant money, the free money that's available for you if you'd like to purchase a home. Please give us a call at 844-790-8255 to talk about your situation, or you can text us your question at 775-237-2266. And so, Melissa, you wanted to talk a little bit about who exactly qualifies for this program. What kind of credit scores are we talking? They have to be the perfect 800 score people?
No, actually they don't. Minimum credit score is at 640. We have different levels, so 640, 660, 680, for different types of products. We can get into that here shortly. But essentially, the maximum income is $95,500, and so that's whoever's going on the loan.
Okay, if the household makes less than 95, or if just one person makes less than 95?
It would be whoever's going on the loan. So if you have a husband and wife and only the husband is going to go on that loan, we'll take into consideration his income. So, essentially if he makes under $95,500, he would qualify.
And I think the statistics bear out that a lot of people here in northern Nevada make under $95,400.
It's definitely a generous amount.
Right, it is. And the other thing that I found is, a short time ago, I closed a loan where the husband and wife between them, they made, I believe, about $140,000 a year. And they came in and talked to me. They had heard about the program, and the husband didn't want to miss out on the free money.
Right.
And so we were able to, get them into a beautiful home just on his income alone. I mean, I think his income was about $80,000 a year. And so we did the loan in just his name, and they were able to get the grant money, where if the two of them were on the loan together, they would not have been able to do that.
They might have been able to qualify for a more expensive house, but sometimes you don't always want to buy what you maximum qualify for.
Absolutely.
Because the payment gets really high, and you don't want to be house poor and never out to dinner, and you want to have a payment you're comfortable with. Yeah.
Exactly. And the other thing with that was that with him, first of all, they were able to buy just an absolutely beautiful home.
Right.
But when we look at purchasing a home, and if we compare a regular non-Nevada rural mortgage with a Nevada rural mortgage, and you calculate in what you got in grant money, and even though the other mortgage, the interest rate might be slightly less, if you're going to stay in that home for less than probably 10 or 12 years, the loan with an interest rate that is, significantly less possibly, it's still going to cost you more to live there if you're in that home for, a short period of time. And most people either move up in a home or move down in a home, refinance a home. The number, it used to be the average homeowner only kept their mortgage for 5 years. Today, I think with the great interest rates we have had and
Right.
with the prices people paid for homes, I think we're going to see that extended out a little bit. But still, most people, if they take advantage of this program, they're going to save money.
Absolutely. Absolutely, they're going to save money. And then, Melissa, you have some other criteria for giving them the grant as well. What are those?
I do. So the maximum purchase price of the home is $400,000, which again is definitely a generous amount since we're talking about rural areas such as Sparks, Fernley, Fallon, Minden, Carson City.
400,000 buys you a nice home.
Gorgeous, yeah.
Yeah.
So maximum debt to income ratio would be 45%. If you're not too sure about that, Doug would be a great person to talk to.
Right, Doug at Academy Mortgage. Now, Doug, that would be, in my opinion, the ratio that gets the most people in trouble. Wouldn't you agree?
It is. And where the problem is, actually with that 45%, people with limited income, what we're looking at for the 45% is we're looking at your long-term debt. Long-term debt would include any automotive loans, any installment loans, student loans. Student loans is just a killer for so many potential first-time home buyers. And then the other thing is we're including the minimum payment on your credit cards. So, well, just the other day I met with a nice young lady who was at one of our other events a couple of weeks ago, and she has somewhat limited income. And unfortunately, they have a Harley-Davidson loan with a payment
That's
of
a big hog,
Yeah.
huh?
right, with a payment of $550 a month. And you know, her total debt that she would have qualified for was $1,300 or $1,400. You subtract out that Harley payment and a couple of credit cards, and guess what? She can't buy a home because she's strapped with that
Motorcycle payment.
that big motorcycle payment. And so many young people, when they get a job, what do? They go out and they buy that nice truck or that fancy car, and you know, think nothing of the $500 a month, $600, $700 a month payment until they want to go buy a home, and now that just, you know, sabotaged
yeah.
their ability to buy a home, even with down payment assistance, because they can't qualify for
Can't
the
get
payment.
the debt to income ratio underneath. Right.
Right.
Debt to income.
Right.
So the thing I always try to advise my clients, working with potential home buyers, et cetera, is that, you know, nobody polices how you spend your money after you've got the house. Okay?
Right.
Really,
Right.
they don't go out there and go, you know, we gave you a mortgage, so now we're going to keep track of whether you're keeping your ratios of debt in line. So if you think you want to buy a new car, or you really want to get that Harley or something, get a house first. And then you can spend the rest
Right.
of your money any doggone way you please. But get the things after you've already
your
qualified
home.
for and purchased your home.
Right. There's no better investment.
Right.
And, you know, where the car or the motorcycle or whatever it happens to be depreciates, and, you know, they always talk about driving the car out of the showroom and it lost half of the value, and I don't know that that's quite accurate, but it certainly drops in value. And with your house, historically, houses...
Hey, they're going up 11% a year.
Right.
Right, and you know, we were talking about that the other day with last year homes in the Reno market increased 11%. They're projecting that that's going to continue for, you know, at least the next 2 years. They're projecting that interest rates are going to go up at least 0.25% a year. So right now our median price home is right around $300,000. 2 years from now, that home is going to be $375, $380, plus your interest rate is going to be higher. Do you project that your income is going to increase by 30 or 40% so that you could afford the same house 2 years from now that you could afford today.
Well, what they talk about all the time is that wages are stagnant. So no, you're not going to, I mean, I don't think anybody in 2-3 years thinks they're going to be making 30 to 40% more money. Melissa's here
I know.
wincing, no.
That would be wonderful.
You might get a raise, but not that big of a raise.
So in reality, right.
Right. But, you know, a common bugaboo that I always like to point out to people is that you don't want to write off every cent of income either when you're doing your taxes. If you're self-employed or you're eligible for all kinds of deductions because you might have a home-based business or something, be careful when you're buying a house, because it is not in your best interest to look like you make $20,000 when you really made closer to $40,000 when you're trying to qualify for a home. Okay,
Right.
and again, once you get the home, you can go right back to writing everything off, but you don't want to do that the year or two that you're trying to get yourself into a house.
Right. You know, I used to have my own businesses, and we paid accountants a lot of money so that we didn't make any money.
Right.
And, you know, that's what just about anybody in business does. And we have people come into us and, you know, they're living large, as they say.
Right.
And we look at their tax returns, and they made $8,000 last year. And, you know, $8,000 wouldn't have paid their rent. And
Certainly doesn't buy a house.
right. And so now they want to buy a house, and they should qualify. In the past, we had stated income loans, which were for people who owned their own business, and these unfortunately were grossly abused. They became known as liar loans, and
Right.
and they're against the law today. And so for these people who have their own business, there isn't a workaround that. So you know, I always say you got to throw the government a bone. You know,
You're
pay
going
them.
to buy a house, throw
Or
the government a bone. Right.
for actually probably the 3
years.
years, or 2-3 years, so that it looks legitimate, and now you will qualify, because we're going to average your income over 2 to 2.5, 3 years when we qualify you.
Okay, good. That's really good to know, and I just can't make that point strongly enough. Tax day is coming up. If you think you want to buy a house, don't write your income down to some small number in the teens, you know, and don't think you got away with something great when you didn't have anything to pay in for taxes, or you got a big refund, because it could hurt your long-term financial prospects, certainly your eligibility for a home.
Also, on the tax topic, last year we just seemed to have all these people who wanted to buy a house and thought they did not have to file their tax returns. And you know, we require your tax returns, and so if you're planning on buying a house this year, please, you know, see your accountant and file your taxes before April 15th. It's going to make a big difference in your ability to buy a home.
Well, it'd make the difference. I mean, you get it. You can't get a loan if you don't have the tax returns filed.
Right. And the final thing on that subject, at least from my standpoint, is, you know, what is the number one source of money for your down payment for your closing costs beside the grant? Is your tax
return,
refund.
right.
And so, you know, get that money, use it for your closing costs, and let's get you into a home.
Exactly. So what else, Melissa?
Sure. So initially we went over the credit scores, and so I'll just kind of give you an idea, basically a snapshot. 640 credit score could be used with VA, USDA, and FHA, and it's a reduced grant at 3%. So if you have a 640 credit score using the FHA program, you can get a 3% grant for down payment assistance.
That's pretty good.
It is.
640, you could work on your credit, but you're at least eligible.
You're at least eligible to get into that home.
Right. Yesterday I spoke to another former attendant to one of these events, and they called me, and when we first talked, their credit scores were down right around 600. And that was, I believe, 9 weeks ago. And so they called me yesterday. Their credit scores are up to 640. And the other thing is that they had a tax judgment, and you cannot get a loan if you've got a judgment of any kind, be it for back child support, be it for not paying your taxes, you walked away from a debt and they filed a judgment. Without satisfying that judgment, you're not going to be able to get a mortgage. But they worked with the IRS. They got their tax judgment released, and so they're going to be probably looking for a home within the next couple of weeks. So that's very, very exciting.
I need to meet this person.
We will.
That's a great story because we get a lot of phone calls at Nevada Rural Housing Authority of interested home buyers that are the very first step. What do I do?
Right.
And they're confused about their credit. And so what I would recommend them to do, call Doug at Academy Mortgage, let him pull your credit, go through it, and see what you need to work on. A lot of people think they need to pay X off when they really need to pay Y off.
Right.
And then they've wasted all that money making a payment on something that maybe Doug could have helped them
Get released.
get in 9 weeks. Raising the credit score to 40 points is amazing.
Right.
And now they're ready. It's tax season. They're going to use that IRS money and our grant and get into a home for the summer.
Oh, yeah. It's wonderful.
Regina and I have another client where, a couple months ago they came to us and they wanted to buy a home and they couldn't buy anything. One of the team's credit score was a 550. And we were able to raise that score in a couple of weeks, or not a couple of weeks, couple months, by over 100 points.
Wow.
And so they went from not being able to, qualify for anything to be able to qualify for the best of loans. Now, in their case, they made too much money to
Get a grant.
to
Sure.
get a grant.
But you help them raise their credit
but
score.
we're able to raise their credit score. And, this is something that we love to do. We love to help you go from somebody that is just dreaming of buying a home to somebody who now qualifies, and we can help you, particularly with Melissa's help, get into a home.
Absolutely. And I was just thinking of a comment that I often make to my home buyers when they're dealing with whether they've got their taxes done or whether they are qualified. I always say that, getting a home loan is not an A, B, C, D, or F proposition. It's not like you can get a C and still get the loan as opposed to getting an F.
Right.
No, this is a pass-fail.
Right.
Yes, it is.
You either pass and get the loan or you fail to get the loan. So you actually have to be really good about all these things. Sometimes people think we're doing the slow drip method to get them to bring in all their paperwork and stuff like that, which we're not trying to do. And they'll just think, oh, I'll get Doug some of it, or I got him enough, it should be good enough. Or, I did my taxes for 3 years running. It doesn't matter, I didn't do it last year. No.
Yeah, it does.
It's a pass-fail proposition. So you agree, Doug?
Without a question. It's the only thing with the pass fail, the difference really is what the loan that you'll qualify for is based on. If we get the score up where you qualify for a loan, then it's a question of how high we can get it will determine just how good a loan that you can get. Melissa was talking about with this, the different credit scores for the FHA loan. And with Melissa's conventional product, buyers can get their conventional product with the maximum financing on that with a 640 score is 95% rather than the 97%. But what happened, the other side of the conventional loan is that although the interest rate is going to be consistent, what changes is the percentage, your annual percentage you're going to pay for your mortgage insurance. So if somebody comes in and they've got a credit score that is 760 or greater, their factor for their mortgage insurance for 97% is
very small.
Very small. It's under 40%, where the person with the 680 score, that jumps up to 80%. And
so the bottom line
0.8%.
is do everything you can to get your credit score up. That's
Right.
one of the
Absolutely.
first things you want to do when you get your interest peaked in getting a house. And then now, Melissa, I was seeing here that they can even use this grant for manufactured houses, for condos.
Yes, they can. It can be used in multi-unit duplex, fourplex, as long as the borrower lives in one of those units. So you could essentially purchase a fourplex I heard you guys talking about on another show that you were talking about somebody doing that in Fallon, a rural area. You purchase a fourplex, you live in one, and then you rent out the other three.
And the other people are paying your mortgage.
They're paying your mortgage.
You're living for free.
How awesome is that?
It's a great, great strategy.
And in that particular instance, actually, the three rents would have more than covered the mortgage payment on it. I mean, that's unusual, but in that particular case, the homeowner would have actually had positive cash flow every month.
So then the tenants are paying your power bill and your
everything.
Everything. And guess what? He could have bought that home. By the time he had his grant and so on, he was, the money out of pocket, there was next to no money out of pocket. The government was, or not the government, but where can you get an investment that pays you a return, appreciates every year, and you're doing it with virtually no money out of pocket. You can't buy stocks that way.
Other people's
awesome.
money,
yeah.
No,
Right.
it's great. It is great. So, okay, but manufactured homes is another strategy people use here in northern Nevada because the housing is so limited. There just aren't enough houses, and so often people will turn to those manufactured homes, and they can get the grant as well.
They can. And being in rural Nevada, you'll notice there's pockets of manufactured homes the more rural you get.
Right.
And so that's beneficial for borrowers interested in getting a manufactured home. The credit score is 680. And for a while there, it went away. We worked really hard to get it back because we have people in Elko that's a huge pocket of area for manufactured homes. We couldn't let them take that away from us.
Because then you're not serving enough
We're
of the
not
population.
serving,
Yeah.
and that's what, we are here to do is help serve people.
A couple of things with the manufactured homes.
Yes.
The manufactured home you have to be buying the land at the same time. You cannot be buying a manufactured home in a home park or on leased land. And the other thing is that the home has to be converted to real property. So it has to be put on either a full foundation. Most of the time they're put on what's called an 8-point foundation, where they basically support all the major stress points in the house. And then that gets converted from personal property, which the manufactured home would be, to real property, and then we can do the loan on it.
Yes,
Absolutely.
that's right. And I'm glad that you brought that up, Doug.
So it's not really a mobile home anymore. It's on a foundation.
It's real property.
Right. The benefit of it was that it was constructed at another location and then brought to where it is now, but it is secured and it is not moving again.
Right.
And that makes it real property, and that makes it eligible for the grant.
Right. Also, something related to what you just said, it has to be where it was originally brought when it was first sold.
Right. It can't have shuttled around the country and then be put on a foundation.
Right. If sometimes people who have a manufactured home, they'll have it for a few years and they'll decide, oh, I want a new one. They'll sell that one and somebody will buy it and put it on another piece of property. If it's been moved from the original piece of property, FHA will not give a loan on
Right.
that.
That's because of the risk of damage to the home while it was in transport.
I guess. I'm not sure exactly,
Yeah.
but that sounds logical.
I went through this on
Regina seems like she's had this
come up a
story.
few times. Yeah,
Right.
come up a few times. So, but now it's a great scenario that we can use that because it's a great alternative for people. It really is.
Especially in the rural areas. Like
Right.
I was saying, there's pockets of mobile homes, and that's just where people live in those rural areas.
Or especially for those who may have lower income that
Yes.
want to qualify to own something instead of just being always renters.
Right.
They can't get, my goodness, I'm struggling like crazy with this $200,000 buyer I've got. $200,000
Yeah.
does not buy you much because he's specific that he wants to be in town, in Reno or Sparks. And,
Dreaming.
well, I have tried to explain that.
Yes.
But anyway, if say you qualify for 110, what are you going to do? you're not going to buy a stick-built house.
No.
You're going to buy a condo, or you're going to buy a manufactured home. You know,
Right.
and believe me, I go to a lot of houses as a realtor, and I have seen some very nice, very comfortable manufactured
Oh, yeah,
homes.
they're gorgeous.
Some of them are beautiful.
Right,
Yes.
right.
Yes.
They look just like a stick
regular
built
house, and they sometimes have got a little land around them, so you feel more rural.
Yep.
They're just great, and I'm so excited that this program will pay for it. Okay, and then we were talking a little bit about what you guys kind of covered the mortgage tax credit, I think. Or
Yes,
did
we
you,
did.
Yeah, we
All
went
right.
over that at the beginning.
with tardy me, not there. And then let's talk a little bit about the annual savings. I mean, those are some big numbers.
Yeah, so at the beginning we were talking about that mortgage tax credit. How we determine what type of percentage you get is based on the loan. For an example, a loan under $225,000, you'll get the 30% of that mortgage tax credit. So for a loan amount of $150,000, we'll throw the 5% interest rate out there. Approximate annual interest is $7,500. With that tax credit of 30%, your annual savings is going to be $2,000 annually for the life of the loan.
And
That's
on
that's
top
amazing.
Of it. Yeah, and that's on top of the mortgage deduction you got.
So
Right.
you do get on that 30%, you can claim the other 70% as a deduction.
Okay.
The cool thing about the tax credit is that you can use that to help you qualify for a nicer home. And with FHA, if you were getting a tax credit that was the full $2,000, we can actually subtract $166 a month from your housing payment. So that allows you, I figured it out.
From your debt to income and
Right.
everything.
Right. So last time I figured it out with the FHA, you could increase your buying power with FHA by about $28,000.
So this person I'm talking about who's qualified for 200 could qualify for 228,000, and that could make the difference between finding something that's available and nice enough for him to live in here in Reno Sparks and being stuck with nothing.
Exactly.
So it's a huge boost to their eligibility and their qualification amount.
Sure.
Right.
And so to touch on that real quick for what?
We got now close to being out of time here,
Sure.
so just one final thought
Sure.
real quick.
So Washoe County, the maximum purchase price of the home is going to be a little bit lower than that $400,000. It would be, in the $300,000, and then the income limit is different also. So if you have that buyer fit into that criteria, perfect.
Ready to
Okay.
go.
Well, let's give everybody a contact number for you, Melissa, since we're out of time. How do they reach you if they want to hear a little bit more about this?
Sure. 775-887-1796.
And that's the office of.
Nevada Rural Housing Authority.
Okay. And
Thank
that's
you for being with
Melissa.
us today,
Thank you
Melissa.
for having me.
And how do they reach you, Doug?
They can call me at 775-828-7006.
It may be hard to believe, but people just like you are